I'd like to thank everybody for coming. It's a terrific turnout for a Friday afternoon, and I can assure you it'll be worth your time. So this is the first in a series of Friday afternoon seminars that the Finance Department is putting on, which we're calling Frontiers of Finance, just focusing on current develops in national and international markets and how they affect us and companies and the job market and so on. So today our focus is on Europe. And we have 4 panelists, and we're going to let each of those panelists say a few words about their particular, the way in which their work involves what's going on in Europe. And then we'll just open it up for Q&A. And we're trying to record this for those who can't make it. So when it's Q&A time, we'll have a microphone to pass around. Appreciate if you could ask your question into the microphone. So let me introduce the panel. Starting off, we have Greg Udell, who's a faculty member in the Finance Department and has a lot of expertise in banking and has done a significant part of his career off and on with the Federal Reserve System, and also has consulted with central banks in Europe. On this end of the table, we have Andrew Ellul, who is here because he is European. So we can all just point at him and say angry things. No, Andrew has a lot of expertise that he's going to share with us as well. So Andrew, thanks for coming. We'll see if he makes it through. Next is .Succo. John joined Kelley this year to help us with our Investment Management Academy. Prior to that, he ran a hedge fund which he founded called Vices Capital, and was former head of derivatives trading at Lehman. And then last but not least, Margaret McLeod, who is a treasurer at Whirlpool Corporation. As I'm sure you would imagine, Whirlpool's got a global footprint, big presence in Europe, so she's well aware of what's going on there. So we're going to start with Greg, and then we'll just sort of go down the panel for a while, and as I said, at the end, we'll open it up for questions. All right, Greg?
Thanks, Scott. Well, I want to talk about Europe, of course, but I'd like to talk particularly about the credit crunch in Europe, something that we could refer to as collateral damage. And here's a kind of an interesting quote from Deputy Governor of the Bank of France. Early in the crisis, April 2008, there is no credit crunch in Europe, and the IMF has been too pessimistic in its growth forecasts for the region. So there's lots of quotes like that we can use that look premature in hindsight. Specifically, what I want to do is talk a little bit about what a credit crunch is, and also the challenges that face those of us who are trying to analyze the credit crunch. And then talk about papers that I'm working on, at least some of the papers I'm working on, in particular, in different areas in Europe, specifically related to the credit crunch. To begin this discussion, I'd like to put up a graph not about Europe, but to put up a graph about the United States, because I think it's helpful in sort of illustrating. This is commercial industrial business loans made by banks in the United States from 1940 until today. Now, you can see that last spike where it goes up significantly, peaks very late in the fall of 2008, and then drops precipitously. And I want to use this to illustrate that the problem that policymakers have, as well as those of us who are trying to analyze access to credit, in looking at data like this, that simply is the data on the amount of lending that's being done. So the first issue is that look at that rise. That's rising in 2008. And you probably all recall that 2008, we were well into the crisis. And it continued to rise actually for several months after Lehman fell. So the issue, and some policymakers, as well as some economists, got a lot of egg on their face by claiming that there was no credit crunch because business loans were going up. A closer look, however, revealed one of the problems associated with looking at total lending. And the problem is that firms were drawing down on existing lines of credit because the commercial paper market had shut down and other sources of finance were not available. So this was not at all reflecting the entire picture. Well, then you think, well, there's the credit crunch, right? Because the amount of lending went down. Well, that also doesn't say that there was a credit crunch, because lending can go down for two reasons. One, it can go down because demand is falling. Well, that's not a credit crunch. Or it could go down because there's been a contraction of the supply of credit. Bottom line here is you can't look at data like this to tell us whether or not there's a credit crunch. So this gets me to what the definition of a credit crunch is. And the short definition is it's a contraction in the supply of credit. We could elaborate a little bit and say it's a tightening of credit conditions such that borrowers of any given risk class find less credit available. Well, what caused the European credit crunch? And more generally, what caused the credit crunch everywhere, meaning in the U.S. too? And that was shocks to the banking system. And specifically, the shocks to the European banking system came about initially because of investments that some European banks had in mortgage-backed securities from the U.S. But then this was exacerbated by homegrown problems. And Ireland and Spain, for sure, are two good examples of this, in that they had their own real estate bubbles of somewhat different origins, but significant real estate bubbles just like we had in the United States. And of course, now we're all focused on sovereign debt, which is creating a big problem for European banks. And of course, there were also liquidity shocks. In fact, basically, the global plumbing basically got clogged up very quickly in the fall of 2007. So what happens then? Well, banks retrench. That is, they contract their lending, one, to preserve capital ratios, and two, to preserve liquidity in a crisis like this. That's why there could be a contraction, and most of us believe a fairly significant contraction in the supply of credit, meaning a credit crunch. But again, as I said, it's hard to measure because you have to disentangle supply and demand, and that requires data to do that. And the problem, of course, is exacerbated because supply effects tend to be highly correlated with demand effects. That is, at the times that we think that they're credit crunches, there also is very likely to be a contraction in demand. And so you have to disentangle that too. My studies in Europe mostly focus on small and mid-sized enterprise. So in Euro world, we call those SMEs. And so I'll refer to them as SMEs here. And we believe, based on both theory and empirical evidence, that in fact, SMEs are more likely to get hurt in a credit crunch than large businesses. I would like to be able to say something about the SME sector in the United States. In fact, I was asked by the TARP committee and by the Financial Crisis Inquiry Commission to comment on how bad and who was affected in the SME sector in the United States. And I told them quite bluntly, I can't. I can tell you a lot about Eastern Europe, but I can't tell you much about the United States because we don't have data on the SME sector in the United States. And in fact, in a colossally myopic decision, the Federal Reserve decided to discontinue the only survey that we had that we could use in the United States, the survey of small business finance, in the spring of 2007. And the reason was it was too expensive. It cost $7 million to do every 3 years to cover essentially, that is to give us a window in on a sector of our economy that's at least $4.5–5 trillion in size. When I do the math, that does not sound like a good decision. So in any event, I can't study this in the United States even if I wanted to. So let's focus on Europe. So what I'm talking about is essentially, initially anyway, the crisis propagating from the United States to Western Europe, where it appears to have had a significant effect on SME access to finance in Western Europe, but then it also propagates to Eastern Europe. So now I'd like to talk very briefly about 4 of the papers that I'm currently working on and have written on the extent of the credit crunch in Europe. So the first paper I'd like to talk about is with Alex Popoff, my co-author at the ECB, and here we focus on Central and Eastern Europe. And this is particularly in the early stage of the crisis. And this is particularly interesting because there was nothing going on in Central and Eastern Europe at that time in 2007 and 2008. The crisis was elsewhere. But there's fairly strong evidence that we find that the crisis had its effect on the access, SME access to finance in Central and Eastern Europe. That is, it was propagated, and it was propagated specifically through foreign-owned banks. One key thing here is Central and Eastern Europe, the Central and Eastern European banking system is dominated by foreign banks. And to show you how much it's dominated, so those top bars, like Estonia, for instance, 100% of the Estonian banking system is foreign-owned. And mostly, but not entirely, but almost entirely, the foreign owners are Western European banks. Only Slovenia, of the Eastern European countries that we studied, has a banking system that's still dominated by local banks. So what did we find? Well, our key results is that there was indeed a significant credit crunch in the SME sector in Central and Eastern Europe. It was worse for borrowers who were borrowing from banks who were in distress, whether they were domestically owned banks or whether they were foreign-owned banks. But if they were foreign-owned banks, it was even worse than if they were domestically owned banks. And we found some evidence consistent with our priors that more opaque firms were affected, meaning firms that were less transparent, firms whose statements, for instance, were not audited. I've written 2 papers on Spain related to this credit crunch, one with Manuel Ellul at Valencia, Lars Norden, who was on our faculty for a year here. And that paper was on the Caja banking system in Spain, which I'll talk about in a second. And then a second paper with Santiago Valverde and Paco Fernandez, where we look specifically at whether SMEs in Spain were credit crunched. So let me talk about the first paper. What we looked at there is we looked at what happened to the Spanish banking system. Why is that interesting? Well, if you look at the first 2 bank stress tests in Europe, the majority of banks that failed in both of those stress tests were the Caja banks. Well, what are the Caja banks? Like all countries, or virtually all countries, there's this sort of non-traditional sector of the banking industry. The S&L industry, particularly the mutual savings, savings and loans and mutual savings banks, and the mutual credit unions in the United States are our sort of non-traditional banking industry. Well, in Spain, the non-traditional banks were as big as the traditional banks. Each province had its own provincial bank that was not stockholder-owned. It was managed by the local government. And without getting into the details, this Caja banking system was completely deregulated in the 20 years leading up to the crisis. These banks expanded rapidly across their provincial borders. We find evidence that political influence affected very much how they lent. It would have been nice if they had cherry-picked the good loans when they expanded to the provinces they weren't in. Instead, they bottom-fed. They picked off the worst loans. And more than that, they picked off a lot of real estate and construction loans. And they have failed absolutely disastrously. So there used to be 50-plus Caja banks. I think now we're down to less than 20 because the Bank of Spain has basically had to put them together. In a separate paper that I'll just mention briefly with 2 colleagues from Granada, we are looking at the pre- and the crisis period to look at how stronger firms and weaker firms have fared during this crisis. And we find that weaker firms, more financially constrained firms, were affected significantly. We find significant evidence of a credit crunch. And interestingly enough, we find something that I would like to be able to do in the United States. I've also found some evidence of this in Japan in a separate study. These firms, these small and mid-sized firms, turn to trade credit when they get crunched out of the banking system. And so trade credit is very important. There's a very interesting paper about trade credit in the United States which shows that big firms that were healthy during this crisis extended a lot of trade credit. One last paper I'll mention that I know Scott's going to want me off the podium here for a second. I've also got a paper we just finished on Italy. And here we're also looking at the SME sector. And we do find slightly different results. So we definitely find evidence of a credit crunch. We don't find any evidence, however, that more opaque firms or riskier small SMEs that is, are any more likely to be credit crunched than stronger firms. That's inconsistent with what a lot of us are finding in other countries. But we do find evidence that if you borrow as an SME from a bigger hierarchical bank, think Unicredit, where lending decisions are made remotely up in the hierarchy, you are much more likely to be credit crunched than if you're not. And we call this functional distance based on a paper done by earlier by my two colleagues there, Andrea Presbitero and Alberto Cesaro. And we find strong evidence of that. And just to give you some sense of access to credit, so in normal times, we would expect to see these light blue bars and the dark blue bars looking about the same. This is based on a survey of firms and whether banks were accommodating or whether they were restrictive. And you can kind of see the Lehman hit, actually. A lot of the studies in Europe are anchored to that quarter in which Lehman failed as being sort of the defining quarter in Europe. And it pops up a lot in the data that was the time when things were the most acute. And the blue bars here are access to credit if you're more functionally distant. Your bank is one of these bigger banks, and we find evidence of that. So I think that's a summary of what I've got to say. I'll stop there.
You want to use this one, or you want to just?
Okay, so is it working?
It's on. Andrew. Go ahead.
Okay. All right. So coming in, my colleague Bob Jennings told me, well, you can start with some analogies between the European Union and what is happening there and the tragedy of the Concordia. There are a lot of analogies, but I'm not going to start from there because, you know, I don't want to copy Italian television, which is full of these analogies at the moment. In any case, all right. So I would like to start by asking ourselves, so the question is, what is the impact of this European crisis on US firms? So the first thing that I would like to say is the following. We live now in a globalized world. If you think about the latest news, about Brazil overtaking the United Kingdom, for example, about the progress of China, of India, I think Europe, unfortunately, that's where I come from, but I have to say this, is becoming fast a sort of a sideshow. And this is the result, the outcome of many years of political indecisions and bad political decisions. And I will reflect more on that later on. So at the moment, from a globalized point of view, US companies may be, yes, worried about what is happening in the European Union, but had these been normal times, we wouldn't be worried more than, for example, what is happening in Asia or what is happening in South America. So why? Because these countries are becoming bigger and their economies are becoming bigger. So why are we worried about the European Union? And why are we worried about the European crisis? It's because these are not normal times. These are abnormal times. So what are the two, what do we refer as crises? There are many different types of crises that are taking place, that are playing out on this stage. I want to focus on two. One is the crisis with the euro. Secondly is a much bigger crisis to my mind and something that is not being given the proper attention, that is anemic growth and huge imbalances within the European Union. So let me start with the euro itself. So the big question is the survivability of the euro. Right? That is, at the moment, the biggest issue. If the euro were to break up, then we have a big problem. That is, though, a conditional statement in the sense that it will be a huge problem if the euro were to collapse in an inelegant, disorganized fashion. If there is some kind of plan to bring down the euro, then obviously there won't be such a big crisis. Obviously, though, that the second scenario is not even we can't even contemplate that because no one wants to contemplate not even Greece being ejected from the from the euro itself. Okay, so the question then becomes the survivability of the euro, but then over which horizon? Over 1 year, over 2 years, over 5 years, over 10 years? So the moment that we start thinking about the survivability of the euro, just 10 years after the establishment of the euro itself, it's a big puzzlement for me. Why? Because this was the one project that had to bring European countries torn by wars, by rivalries, so on and so forth, together. So ironically, it may, if it collapses, will bring the European Union to separate, essentially, European countries to separate. So it's very ironic that the project that was thought to be essentially the mechanism through which these different countries were to be brought together can bring us apart. Okay? What is the likelihood of the survivability of the euro this year? I think it's very high. For a simple reason, politicians in Europe have shown huge skills in papering over problems, in putting the problems under the carpet, especially this year being an important election year in some countries, for example, in France. So I think politicians will do whatever it takes to make the euro survive this year, or at least in the short term. The doubt that we have is essentially what will happen over the longer period. The longer period, though, we don't know. Why? Because the structural problems that were exhibited with in the introduction of the euro are still there. So if you think about it, I'm not an economic historian, so I may stand to, I may make a mistake here, but it seems to me that at least in the last century or so, the euro is the only currency that essentially was based on one pillar, right? A central bank. All currencies have two pillars: a central bank and the treasury, a minister of finance, right? Which is essentially for the entire currency area. This is not there, and no one wants to go there. There are German problems with this. I can understand Germans. Many people are bashing on the Germans in Europe, but to a certain extent, why would Germans go on increasing their pensionable age, and then Greeks or Italians or Portuguese or Spanish would retire at 45 or 50, right? Why? Right? So I can understand the German point of view to a certain extent. I'll come back to this later on. So I was saying that the main problems, the main structural problems that there were in the euro remain there. We have not solved them, and we are not going to solve them with these politicians. Okay? So I have big question marks about the survivability of the euro in the long term. What this means for US companies, not only US companies, but many companies all over the world, this is a lot of uncertainty. There will be a lot of uncertainty because of this. It's essentially, this is a problem, a slow-moving problem that nobody wants to solve. Obviously, there is the benign scenario where at one point, some countries will decide to essentially take bite the bullet, which we have not done, and introduce structural solutions to these structural problems. For example, I know Italy very well. Italy has shown historical resilience in crisis times. Very few of us remember that in 1991, 1992, Italy was going through the same problems. Italy emerged in a much stronger position. Italy and Spain and other countries have shown a lot of resilience during times of crisis. So I don't put past the abilities of these countries to solve the problem of the survivability of the euro, but I see it unlikely if nothing changes and we continue with the same policies. The second, and I stop on the following problem, the second problem that I see that nobody in Europe, except few politicians, the only one who's sort of the exception is Mario Monti in Italy, who's an economist and can understand certain things, is austerity is important, meeting deadlines is important, especially the next quarter is huge for the euro because in the next quarter there will be European countries have to raise 218 billion in bonds and 300 billion in short-term notes. You can see how big can be this problem. So that I understand. But the biggest problem, the other big problem at least, is anemic growth. Right? And if you go and read what Standard & Poor has said last week, it's essentially repeating this. Nobody's giving it a lot of importance. That is, fine, you are doing the austerity, but there is no path on how you are going to get out of this system, out of this problem. How are we going to get out of this problem? We need, in Europe, we need growth. So Italy has been growing at the rate of what? Average of 0.5 over the last 12, 13 years. Right? Other countries have shown the same amount of anemic growth. And at the moment, the focus seems to be only on austerity, only on meeting this quarter's financial balances, so on and so forth. And we are not taking into consideration the broad picture of we need growth. And growth is not going to come from the sky. Growth is, you need to fight for it, right? And you ask me, so what do you propose? If you go and see many of the labor markets in Europe, many of the internal markets in Europe are still very inflexible. Not only the labor market, there is a lot of inflexibility in the European countries. So I think, and in order for these crises to be solved, you need, and European politicians need to think about two things. One is the survivability of the euro. And secondly, is a big push for growth. Now, obviously, government deficits and public debt are what they are. You can't ask Italy to make more expenditure. You can't ask Spain to increase its expenditure. The Spanish government, the new Spanish government has increased taxation, not decreased it, increased it. That may sound very puzzling for Americans. Why do you want to increase taxes in the face of a recession, right? In the face of a recession. This is what has happened over the last month. So that is not a channel that can be used for growth. What can be used for growth is essentially to relax all the inflexibilities there are in many markets. Obviously, that is what? That means that there will be a big political fight within countries. Today, I just looked at the Italian newspaper. In order for the Italian government to introduce flexibility for their taxes, so, taxes like the caps, right? The caps that transport you from point A to point B. In Italy, it's inflexible. You need a license. The number of licenses is closed, and so forth. To increase the number of pharmacies are regulated in Italy, okay? It had to take 8 hours of cabinet meeting in order to introduce some flexibility in simple things. And that shows you a lot of political problems that may lie ahead in order for Europe to get growth. Without growth, I think the survivability of the euro in the long term will be very questionable.
John? Great. Just take this here. Talk to this. Very, very good points. The only difference I see between the United States situation and the European situation is that we've been able to hide it a lot better. And it goes into what he mentioned about the two pillars, monetary and fiscal. The problem with the Maastricht Treaty as it was written way back when, and I was too young to be one of those to recognize it, but I remember talking to people who said this is eventually going to be a problem, is there was no fiscal rules set in place. So Germany can't tax Italy. Germany can't force Italy to do anything. They can threaten Italy, with austerity. They said, we won't lend you any more money unless you do this. But there is no fiscal relationship there. And some people now have introduced ways to save the euro by bolstering the fiscal leg of this thing. We don't know how it's all going to turn out, but that seems to be what the push is. So the United States, though, has the same exact problem. We have an immense amount of debt in the system. And what I'd like to do is just kind of back up and try to explain what the problem really is and how we got there. And a lot of people put it in terms of we have a liquidity problem. Some people say we have a solvency problem. I'm definitely in the solvency camp. Okay? Liquidity doesn't seem to me to be the problem. We tried and again 3 times or 4 times with quantitative easing in the United States, and it really seems not to have done much good whatsoever. Now, what I started here with, and I could have started really kind of in 1987 when Alan Greenspan took over as chairman, we had the crash, the stock market crash, and Greenspan responded to that crash by providing a tremendous amount of liquidity to the system. One thing he did, besides adding liquidity, was he lowered banking requirements. A lot of us were critical because he never raised them again. And it seems to me that central bankers always err on the side of being looser than they should be. And it has to go into what is the real root cause of this. And the real root cause, I believe, is there's something called a natural rate of interest. This is a rate of interest in which I am willing to lend and someone is willing to borrow. In other words, there's a certain amount of risk in that transaction. And so that interest rate, which is the cost of money, reflects that. Now, when you get a credit expansion like we've had over the last 30 years, what tends to happen is that rates of interest are lower than that natural rate of interest. And the only way those rates stay lower than the natural rate of interest for long periods of time is for central bank policy to basically enact that. So here we are in 1990. This is what I call the liquidity pool. It includes the money supply, but it also includes other things. For example, derivatives, securitized debt, and then bank loans. So this is the entire liquidity pool in 1990. Added up to about $22.8 trillion. By 2001, that liquidity pool was $170 trillion. And what I want you to notice is I've also put percentages here as to which category grew. By 2008, this liquidity pool was $771 trillion. This is what I mean by a credit expansion, by the natural rate of interest being higher than what prevailing interest rates really are. And that encourages people to borrow. Doesn't necessarily encourage people to lend. There are other factors going on there. For example, Fannie Mae and Freddie Mac came in, guaranteed a lot of those loans that banks were willing to make, which fostered that lending to continue. But look at the size of this liquidity pool. It's absolutely immense. But notice where the biggest portion is. It's in the derivative section. And this is what kind of my specialty was, running a hedge fund. Now, what are derivatives and how does that create liquidity? Well, the largest market is the interest rate swap market. And $600 trillion. It's probably about the same right now. And what the interest rate swap market is simply fixed for floating swaps. So if I'm a bank and I have a lot of floating rate risk, I might go into the swap market and swap my floating risk for fixed. But the problem is that that market requires extremely low margin in order to put on that trade. The other side of my trade might be just a trader, some institution, some insurance company. And the problem is that they only have to put up a very, very small amount of money, about 50 basis points. This is one reason why we hear all these talk about, well, we need to take all these OTC derivatives and put them on an exchange. Well, I believe the reason they haven't done it is because once you take it from the OTC market and put it on an exchange, all of a sudden you have to put up 10%. 50 basis points is a lot different than 10%. In fact, if you quantify it, it probably comes out to about $38 trillion of new margin that the system's going to have to come up with if we take OTC derivatives and transfer them to an exchange. So the size of the liquidity pool has gotten here by credit expansion. Now, forget about inflation being increasing prices. In my mind, a very simple way to think about inflation is an expanding credit pool. You make more loans, the liquidity pool grows, the money supply grows. Okay, that's inflation. You're inflating the money supply. You're inflating the liquidity pool. Now, what does that do? When people have more money, they drive up prices. And so there is a very high correlation between what I think inflation is, which is an expanding credit pool, and rising prices. And you get to a point where that liquidity pool or that amount of debt in the system, in the United States, in 2008 and 2007, you took total debt and divided it by GDP, it's about 380%. Today, 380%. You hear Ron Paul talk about what is the solution. The solution is liquidating the debt, okay? And the problem basically is, and I remember arguing with people about the amount of debt doesn't matter. All that matters is the amount of income against that debt, and that's true. But the problem is that once the amount of debt gets too big relative to the amount of income to support it, you begin to deflate that pool. In other words, you begin to have pressures that want to make that debt correct or go down because you just don't have enough income to support it. And so in 2008, that's what we saw. We saw the beginnings of a deflation. Inflating is the expansion of that credit pool, and deflation is the deflation of that credit pool. A deflation is simply a corrective process. It's correcting an inflation that has gotten out of control, and it's too big, and there's too much debt. And so the solution either becomes we have to increase our productivity or growth in some manner to grow our way out of it, or we have to reduce the amount of debt in the system. And so that's what we see. We see instead of an immense amount of productivity, I mean, if we came up with cold fusion that reduced our costs dramatically, that could be a solution. But it would have to be a major solution at this point to offset all these deflationary pressures. So that's how I define it. And inflation is you have a liquidity pool that's based on a natural rate of interest that clears the market where everybody says, okay, the amount of risk makes this interest rate the right interest rate. But if you keep interest rates lower than what that interest rate is over a long period of time, you get an expanding credit pool that becomes untenable. It grows too much. And you have a direct relationship between growth and the growth of credit. So have we really had all this productivity, or have we just had an expanding credit pool that's given us more and more money that is extended to more and more people to allow them to borrow houses they can't afford, and then subsequently now we see that those collateral values are being driven down and they can't be supported. So now we're talking about things like writing off mortgages or reducing mortgage outstanding. We're doing everything we can to support a credit pool that is just too large. And so if you're more on the libertarian bent like I am, or a Ron Paul or whatever, you would say that, okay, productivity is great and we can, hopefully we can grow our way out of it, but we have to be realistic. The debt pool is just too large, and we cannot continue to have interest rates lower than the natural rate of interest. And in fact, the solution might be to let interest rates rise because people on fixed incomes are not earning anything, so they're not consuming. They don't have any consumption, so consumption will drop because of that. Or lower taxes, or do something in that way to increase productivity. Thank you.
Thanks. I'm going to talk to you in a much more practical way than theoretical. The theory is fun and exciting. I want to give you just a little bit of background about Whirlpool so you can see what our list of concerns with the European situation is. We've got $18 billion of revenue. About 20%, just under 20% of that is in Europe. Until a couple of years ago, Europe was our second largest region, and now it is not. And that's pretty interesting. Latin America has taken over, from our perspective, from Europe. As you've seen, a lot of growth in the middle class in Brazil in particular. When we take a look at what's happening to our business in Europe, we see in our third quarter that there were flat, no growth at all in number of appliances sold. We're in a third market position in Europe, first in most of the rest of the world. But yet the unit growth for the European appliance market flat. What does that mean? I mean, basically means nobody's buying anything. So that people who are maybe not building homes or they're not replacing serviceable appliances, they're only buying things when they break. And that's a big difference for us. On a local currency basis, you can see all this is public. We had a 3% decline in revenue in Europe in the third quarter. And we project that the appliance industry in Europe will have no growth this year. So, what happens when that is a situation? And that's probably going to be a little bit harder on consumer durables where we are than some other consumers. But still, the European consumers simply are not buying anything. And that really is our primary issue with the situation. There's lots of currency things that we'll talk about, but decreased demand is ultimately the thing that drives us to make decisions which are not productive for European countries, for example. We announced in the third quarter a restructuring that will happen over the next 3 years. We're going to spend $500 million with the intention of saving $400 million on an annual basis by the end of that. That includes a 10% reduction in our combined North American European employment pool. Why is that? People aren't buying appliances. So we need to do that in order to remain competitive with the remaining size of the market. We're going to be fine, but some of our suppliers are not. We saw this in 2009 as credit contracted in the U.S., that we still had access to credit, but our small to mid-sized suppliers really did not. And that was a very interesting time for me, I can tell you, 2009. This European thing seems like 2009 in slow motion to me. In a way, I wish it would just hurry up and get done. Okay, but things go more slowly in Europe than they do in the U.S. But it's following a similar path, only it's one step at a time, somebody just sort of nibbling away at you. Suppliers, this is a big deal. In 2009, as we entered 2009, we'd had a supplier finance program in place for about 4 years. And what that means is that our suppliers could take their receivables from us, so our promise to pay them in 30 days or 60 days or whatever, they could take it to a bank and get money now if they wanted to. We had been working on that program for 4 years. We had $25 million outstanding. Clearly, it was not a very popular program. During 2009, that went from $25 million to $200 million. And why was that? Because our suppliers couldn't get money from their banks. So I think that was what we were touching on before. And so I don't have the data set either, but I observed in 2009 that those people were having a really hard time making payroll, buying tooling, doing the basic stuff you need to do production. And we assume that this is going to happen in Europe, only in a more slow process. So what are we doing about that? We have increased our monitoring of our suppliers, just because it's a big deal for us. If our suppliers can't supply a part, they can shut down our factories for a single small little widget thing. We stop making refrigerators today, right, if it doesn't arrive. So we care a lot about our health in our supply chain. So we've increased monitoring there. Hopefully all of our suppliers make it, but we're seeing ourselves contraction in the credit markets. For example, we have local banks in every country, right? Because you got to get payments in and out and all that boring kind of daily stuff. And our Greek cash management bank came to us and said, we don't really want to be in Greece anymore. So we'll be gone in February. They told us that in November. We typically do, to change a bank, we will do a survey about which are the right banks and what are their services, then you make a decision, then you spend 6 months implementing it. So the cash management director called me and said, I got a problem in Greece because our bank is leaving the country. And I said, okay, let's see, RFP time. How many non-Greek banks are there? He said, there are 2. I said, which one do you like? He told me. I said, good choice. Let's do that. Okay, that was the RFP. And because we have to have everything moved by February and customers pay to the account they're used to paying to. This is very difficult to change that over in a quick period of time. Likewise, we're seeing those same banks dropping out of credit facilities. Good news for us is we finished a 5-year credit facility last June. We have a fair number of European banks in our facility, and they're contractually bound to lend to us. So they can't leave us, but if we were redoing that facility today, I hear from the syndication desks in New York that there's a number of those banks that just simply are not lending anymore. Why is that? So I asked some French bankers, what are you doing, guys? I'm hearing all this stuff. And they said, well, we've got capital requirements that we need to meet for the international arrangements called Basel III. I was so old to be around for Basel I. But Basel III is supposed to be implemented in a few years, but they have accelerated all of the capital requirements. So this particular bank was planning to meet the requirements by 2013, January 1st, 2013, a couple of years ahead of time. Now they're planning to finish by June. Well, okay, you got 2 ways to meet a capital requirement. You go issue capital. Yeah, it's not such a good day to issue bank capital in Europe right now. You're not going to get much there, or you shrink your balance sheet. And so they've chosen to shrink their balance sheet to get there. So that is going to put a lot more pressure on these small to mid-sized companies and anybody else who happens to show up needing money. So we are also monitoring our banks really, really closely. We used to kind of at the end of the quarter say, where are all our deposits? Does that feel good? Yeah, it feels fine. Now once a week we're watching the credit default swap market, which I'm not a big fan of the credit default swap market. I'm not sure it's a real market. But changes in that market, there's somebody out there who knows about the credit default swap market. It's not quite a real market, but changes in that market are really interesting to watch. So we have been watching that on a weekly basis and making deposit decisions to rearrange our banking based on changes in that market. That kind of conversation never happened at the board level before. It is now. Also, there's a new SEC requirement that came out a couple weeks ago that asked for increased disclosure on sovereign debt and other, the way I read it, other foreign assets in Europe, where they're asking for disclosure by country. They're asking which are derivatives, which are cash. It's primarily for financial institutions, but it seems to apply to everybody who's an SEC filer. So you're going to see a lot more stuff out in the next few months from U.S. Securities issuers. So just a lot more stuff going on in that arena. Our primary interest here is to maintain access to credit for us and for our suppliers. We are also watching, because of the credit quality of some of our local banks, we're changing cash management. So daily cash has to come through the bank you have set up. If you don't like that bank, you need to change it now. It's sort of a game of musical chairs, right? If that bank fails and they're your cash management bank, they will have some of your money. It just will, because they're doing collections every day. So we are moving away from those banks and creating, over time, more pressure on them also. We're watching our derivative counterparties very carefully. That we've been watching for a very long time. We use good derivatives, not evil derivatives. We use derivatives to manage our interest rate risk, our foreign exchange risk, and commodity pricing. We do have now a list, a do not trade list for our counterparties that all of the Whirlpool Treasury people around the world have that list. And so we're not sharing that with our banks, but there are people we're not trading with anymore. Somebody asked me to comment in our last board meeting about how I'm going to deal with currency problems if the euro breaks up. I have no clue, because how is it going to break up? Is it going to explode? What's it going to turn into? How will contracts be settled? There are no known answers to any of this speculation. So, in the normal course, we hedge our currency exposures. We're continuing to do that until we get some clarity about what exactly that means, right? I mean, if Greece leaves the euro and the drachma devalues 50% overnight, I guess I'll feel bad that I didn't have a drachma hedge, but where am I going to get one? So those are just risks that we're going to have to live with for the time being. But we're also starting to look at practical questions like, okay, if Italy, we have our European headquarters in Italy, so it's a big deal for us. If Italy were to leave the euro, which I actually can't imagine that happening, but if they were, how would we make payroll that week? In what currency? What if the banks are closed? And almost certainly they would be for some period of time if that were to happen. How will our systems consolidate our financial statements? We don't even have a currency in there that's the new lira or whatever it would be. And so we're going through contingency planning, dealing with lots of interesting questions. So maybe, I guess that's about all I have to say. Okay.
Okay, let's have a round of applause for our panelists. Right? And then why don't we start with questions from this area, since that's where I am and the microphone is, and we'll just sort of move around. Who has a question?
First of all, thank you very much. I have a question since we compared the European crisis with the American one, and we talked about the two options of maybe walking out of it, meaning reducing the debt pool while holding productivity, or the other way around. How much do you think we can learn from Japan, being a country that has been basically stagnant over 20 years, and how that crisis might relate to these two, and how much we can learn from it?
Well, I think we learned from Japan that stimulus just doesn't work. Japan is really, in my opinion, going down the same course that Japan went down. Japan expanded credit too much in the 80s. They had a lot of foreign currency reserves from exports. The interesting thing is they didn't just buy treasuries, but they bought Rockefeller Center, and they bought Pebble Beach, and they bought a lot of stuff, which hurt them very badly in the crash of '87. They basically had to repatriate all of that back to Japan at a very, very discounted rate. So it really hurt them. And I think that probably set them into a deflationary spiral much quicker than what we have experienced. But I think the lesson from Japan is that, just the stimulus doesn't work. They did the same exact thing. They defeased their private debt. In other words, the banks were lending too much, and they had a very strange, they have very strange relationships where they have crossover ownership. The banks own the corporations own the banks, the people own the banks. It's all kind of owned together. So one bankruptcy would probably set up a series of bankruptcies. So the government of Japan basically defeased all that debt. They basically bought all those bad assets from the bank, and they put it onto the balance sheet of the government. This is why the government debt in Japan is 220% of GDP. But if you look at what we're doing, we're fast on our way. We're at about 100% government debt to GDP, and it's growing. And that doesn't include Fannie Mae and Freddie Mac. So I think that's the lesson that we have to learn, that kicking the can down the road isn't necessarily the right way to go. I don't have the answer at this point. But I do know that lower prices, if we did begin to liquidate debt and hold those responsible who lent the money and let them take the losses, what would happen is prices would drop, and at some point it would begin clearing the market again. The inventory that we see, the 8 million homes of inventory that we see out there in the United States would begin to go down quite rapidly as the price of those homes dropped. So I believe in markets, okay, and markets are you and me. It's not the government telling us what to do or a central bank telling us that interest rates should be here. It's you ourselves telling us this is where interest rates should be, this is what I should be doing with my money. And so I think that the markets, it would be ugly, but I think the markets would heal the situation much faster than if we just keep trying to stimulate and kick the can down the road.
Can I say something? I don't want to say anything about the stimulus, not because I don't agree with it. Even if I were to agree with it, there is no money. So it's useless to speak about the stimulus. Who is going to spend the money? Italy has 120% public debt. Spain is also very high and has raised taxes. France has a big public debt. The only country that has something to spend is Germany. But one lesson that we have learned over the last few months is that the markets reward the thrifty guys. Even the Standard & Poor, if you look at the countries that Standard & Poor has not downgraded, are essentially those that have high savings or low public debt. Germany, Finland, Luxembourg, and the Netherlands. The only problem was Austria. Austria has the same benefits as Germany, but Austria is close to the periphery, being Hungary and Italy. Okay? So it's useless to think about, well, would stimulus work? To me, it's a moot point. We should not even waste 1 second thinking about stimulus, because where's the money coming from?
Where is austerity working?
Yeah. So austerity, fine. So austerity, I'm not going to go there because otherwise we'll go into this issue of stimulus work, austerity work. So the problem here is the second point that I want to make is that Japan, to my mind, has very little to teach us on this, because the situation now is different. It's in the case of Japan, it was one country going through a problem when it was surrounded by growth. The problem is that at the moment, Spain cannot do austerity and going to have a benefit for a simple reason, because everybody is doing austerity at the same time. This is the problem. Italy is doing austerity program. Spain is doing austerity program. Portugal is doing the same. The United Kingdom has done the same. Germany does not want to spend. America is doing the same thing because obviously there was a political shift. I'm not going to go into that. I'm just giving you a positive statement. Nobody wants to spend, right? Either nobody wants to spend or nobody can spend. So now, the only lesson, the only solution that I see to this problem is not Plan A, it's not Plan C, Plan B, Plan C. Perhaps it's even Plan Z. Essentially, governments in Europe, I want to focus on Europe because the problem, the subject of the matter today is Europe. They have to become two things. They have to become very creative, and they have to become very courageous. Why creative and why courageous? Creative is that they have to go and start freeing up a lot of inflexibilities in the markets they have, right? Why courageous? Because doing that will cause huge political upheaval. So this week, it's a surreal situation in Italy where cab drivers are saying, I don't want to pay taxes to the last communist government in Europe. Like, these guys have been having it too good. The cab driving market, I have nothing against cab drivers. I normally have great conversations with them. They are great people. They speak about football and soccer, whatever it's called. So I like them. I really love them. But this does not mean that you continue extracting rent. There are so many segments in the European economy that is extracting rent at the moment. And governments have to start removing that. So again, the second point that I made, and I'm glad that Margaret mentioned it, the problem, one big problem that nobody's focusing on is growth. How is growth coming on? So austerity is not giving its benefits because Spain, if Spain was in a recession, and Europe, the rest of Europe was doing very well, that's okay. You have the external sector to balance you out. But the problem is that when you have this uncoordinated sort of actions, where everybody is constraining at the same time, is restraining expenditure at the same time, you have a problem. So stimulus also, there's nothing to speak about because there is no money. the bank is closed, as they say in Italy. There's no money. So what we have to do is start introducing competitiveness in the economy. But that will be very difficult politically speaking, because it will make people stop extracting rents.
I just want to make one comment, because everyone here is a student. And you have to be a student of the markets to understand what's going on. I believe that Japan is related, because we're only talking, take a step back, we're only talking about 20 years. 20 years is nothing in the history of economics. And I believe Japan was the first domino of many dominoes. So maybe the first domino was Japan, second domino was US, third domino was Europe, who knows? The problem in my mind is that, just to repeat it again, is that there's too much debt in the system, that we borrowed, everyone has borrowed. Look at what's going on. Every country in the world wants to devalue their currency. That seems to be the solution here. And it's an impossibility. Every country can't devalue their currency because currencies are cross currencies. They're related to each other. But I just want to suggest to you that when you study these things, don't just look at this year or the last 6 months or whatever. 20 years is nothing in the length of an economic history. So I believe that 1999, the crash of 1999, was related to 01, was related to the correction in 03, was related to the correction, the big correction in 08. And you have to look at it as a series of events that encompass not just 6 months, but a long period of time.
Yeah, I'd like to pick up on this Japanese. I've spent a month at the Bank of Japan studying crisis there, looking at some of these issues, and I think I'm basically on the opposite page that you are. I think there are except to the extent that there are striking parallels between Japan and the United States, and one of those parallels is there was a real estate bubble in both countries. It is not as clear in the United States whether that real estate bubble came from monetary policy or not. That's a completely unsettled question in economics. It is very clear that that was true in Japan. That bubble popped in April of 1989. The second thing that's clear is neither country felt a strong commitment to regulate its banks. And as a result, on a couple of dimensions. And on one dimension is it was clear as a bell that regulators allowed banks to pile up investments in the real estate sector. So if you just do pie charts of large banks and small banks, some of you are in my class have seen these pie charts, you see a buildup in the decade preceding in real estate lending, and including construction lending. As an ex-banker, I can tell you, construction lending in traditional banking is the riskiest kind of lending. Regulators let them do it. In addition to that, we gamed, that is our banking system, gamed Basel I in ways that allowed them to get as much as 50-to-1 leverage on investing in subprime mortgage-backed securities. In that sense, I would draw a parallel with Japan. Next thing is the crisis looked a lot the same. We had two investment banks, Yamaichi and Sanwa, fail in Japan. We had Lehman Brothers and Bear Stearns fail. I could go on and on about the parallels. Both systems were completely ill-equipped legally to handle the resolution of large, complex financial institutions. And yet we sat there as Japan crashed and burned and arrogantly said, well, if this happened in the United States, we could handle it. And then we found out we couldn't handle the resolution of a large, complex financial holding company. And we also found out we didn't really believe in regulating banks. So I think we have to understand where financial markets work and where they don't work as well, and where you need regulation. And when you have deposit insurance to prevent bank runs, you are automatically in a world that deviates from the perfect markets that we talk about, and I think the markets that you're talking about. And when we deviate from that, we can't turn a blind eye to the fact that you've got to regulate those banks. You can't allow Citibank to stuff $500 billion of subprime mortgages in special investment vehicles with a 50-to-1 capital ratio.
If you're implying I said that, please, I did not say that. So
Well, what I'm saying is that, well, I'll tell you exactly what I'm talking about. I thought I heard you say that we can allow markets to be markets. And I'm saying that's a market that you can't allow to be a market. You have to regulate that
I
market.
agree you regulate markets. But
Well, then we are on the same page.
Yeah, we are.
Okay.
Well, I'm glad we got that settled. How about this?
I was short city court huge because of that. It's crazy.
It was amazing,
Unreal.
just amazing.
You all have touched in various ways, some directly and some tangentially, upon growth, upon austerity, and things of that nature. And this also has to do with the parallels between Japanese, American, and European economic situations. To what degree do you think demographics are a factor? And the fact that, you know, in Japan you had a very aging population, in Europe you have an aging population supported with a lower birth rate, whereas in the U.S. you still have a lot of immigration, you still have a higher birth rate where you do have younger people coming in to take care of some of those, the costs of social welfare programs. Do you see that changing anything in terms of the future course of austerity and the unraveling of some of these debt issues in public policy? Just the demographic difference between the countries, or do you think that's insignificant?
Okay. So again, when you ask a question like this, what will be the impact of this on the future, right? You have to ask yourself, what horizon are we speaking about? Okay. So the horizon in French policy, for example, is 6 months now, because 6 months is the presidential election, right? That's right. The horizon in Italy is 1 year, right? So if you are speaking about the most pressing needs, right, I don't give much weight to that. If you talk about secular changes and you want to really have a discussion on what is really needed from a policy point of view, if we want to solve the problems, for example, in Europe, again, I would like to speak about Europe, then yes, it's crucial. So it's very easy, right, to make certain calculations. Let me give you an example. The only way Austria, which is a very well-run country, right, can continue having the type of welfare state that they have, that they need 400,000 new human beings in the economy every year, right? Right. Now, the question is, where are these 400,000 human beings coming from? You either produce them internally, right, or you import them, right? Now, they are not being produced internally, so they have to go. That is the truth. The truth is that the only growth in population in many countries is essentially immigration. So immigration for Europe is extremely beneficial, extremely beneficial. I know that it can cause a lot of political problems. You can deal with those, but immigration is very important. That means something. If in Europe we want to keep on having the same welfare benefits that we have, there is no solution other than having new immigrants. Okay, and this flies in the face of the Northern League Party in Italy. The Northern League Party in Italy bashes immigrants, but then the base of the Northern League Party are essentially small entrepreneurs. Right? You know who are the employees of these small entrepreneurs? Are essentially Albanians, Romanians, Africans, so on and so forth. Okay, and then they bash them, but they employ them for right. So there must be some consistency there. So I guess immigration is a very good thing, and if we want to keep Europe on that regard has a big choice. Either they restructure the welfare state, in which case there will be political upheaval, or they will need immigration.
I have a question for Craig. You know, by hindsight, there's a lot of things you do over the U.S. Treasury and Fed might have saved the Lehman Brothers. But it's my understanding the European Central Bank in 2008 told the banks that sovereign debt was risk-free and they could buy and not have any capital requirements. I've heard this, but I've never seen any evidence on what that did in terms of banks holding sovereign debt. Obviously, the problems have been going on for 20 years, but was that decision a bad decision?
I have not heard that they changed their policy on that, but under Basel I, it has a zero risk weight, which means that the policy always was there were no capital requirements against sovereign debt. So the issue really was, were they ever going to modify the requirement on, and of course they don't have the authority to do that. The central bank's prudential supervision is not an EU-wide. So they only have the authority about whether they accept sovereign debt, you know. But I would not be surprised if that's true, because and of course, if we go back to the first European bank stress tests, which were in 2009, the one thing that was, so this just gets to your point, the one thing that was excluded. So nobody failed the first European bank stress test. Markets did not move after that stress test, while markets actually moved when we did our stress test, because the majority of banks actually failed the stress test. Nobody failed the European stress test that had not already failed. So those were 4 Caja banks, 1 Greek bank, Allied Bank, the big Irish bank that failed like 3 weeks later, it passed the stress test. So what was excluded in the stress test, interestingly enough? Sovereign debt. So what you're talking about I hadn't heard, but it's perfectly consistent with everything else I just said. Yeah, and of course that's a big problem. I mean, so I think most economists, as well as most practitioners in the marketplace, understand that Greece needs a 70% haircut. And so one of the issues is how do we get that? That the Greece can pay back only about 30%. That is, it can only cash flow back based on the economy as it exists now, and yet of their total amount of sovereign debt outstanding. And so a good friend of mine was section chief at the Federal Reserve Board in the international division, and that's her calculation. It's been her calculation for several years, and that's the number we all keep hearing. And yet Europe seems to be playing around with these crazy schemes in which some people take a haircut, the ECB doesn't take a haircut, and now there are all kinds of articles this week about hedge funds getting ticked off about this, and we can't blame them, because apparently they are going to have to take a fairly significant. Those guys are getting ticked off, and so. But Greece is the bigger question is Italy. So Italy is the 3rd largest sovereign debt issuer in the world. The vast majority, I believe, of repos in Europe are Italian sovereign debt. And then the issue is, the big issue is, what are we going to do with Italy? And of course, Spain is next, although Spain's problem was never fiscal irresponsibility. So one of the interesting things is there's a perfect example that good fiscal responsibility didn't help Spain a bit. Spain's problem is private debt. Now it's got a sovereign debt problem because it's paying this big whopping risk premium. But it went into this crisis with a very healthy sovereign debt to GDP ratio. So it doesn't fit this model we've been talking about at all. It's actually quite different. But it had massive private debt.
So can I say something about Italian debt, because this is a very important point. If I want to link with what Margaret said, is sort of their headquarters is in Italy, and Italy is very important. And obviously, if Italy gets out of the euro, then I think there will be blood on the floor, and the euro will have to wave goodbye to the euro. I am not so bearish about Italian debt for a very simple reason. There are many negatives about having huge debt. There is one benefit, though. One benefit is that you develop skills and knowledge and know-how on how to manage that debt. And Italy has been managing for a long period of time a huge debt. I happen to know some of the guys in the Treasury, in Italy. They are the most prepared, the most technically prepared, the most serious guys I have ever seen in my life. They know what they are doing. They have been doing this for a long time. So I want to focus on the soft sort of capital here. They know how to deal with that. Secondly, Italy has one of the biggest savings ratio in Europe and in the world. Many Italian households are sitting on high savings. And if you think about Italian debt, almost 70% of the Italian debt is held by Italian households.
So let me ask you.
So as long as Italian households, and there is a movement, an nascent movement, they call it the bot movement. The bot is essentially is the name for Italian treasuries. It's essentially these guys saying, get out of bank deposits and buy these treasuries. So when I speak with my friends in Italy, even for example, people in finance, they don't have any problem with seeing, well, who is going to buy this? Okay, because Italians are not even, I want to draw a parallel between 1992 and 1993, what happened in Italy and what is happening now. Even 1992-93, a lot of Italians bought their own debt. Okay, so somehow I'm not so bearish about the Italian debt as much as many of you are in this room, although being critical of many other things.
So let me ask you, I was at the Bank of Italy on Unification Day last spring, celebrating the 150th celebration, working at the Bank of Italy, actually, and in Rome. And not everybody in Italy celebrated. So you mentioned the Northern League. They weren't celebrating this at all. And friends that I talked to in the Bank of Italy, economists, kept stressing that this notion that Italy is really at least two countries, if not three, artificially put together, and that the stress now has grown between southern Italy and northern Italy. So are you describing all of Italy, or are you describing northern Italy, or is it just not the case that the stress between northern and southern Italy, the Campora, the Sicilian mafia, and everything else? Right.
Okay, so I can stay here discussing this issue for a long period of time. Let me say just one thing though, that many people did not celebrate the
I want to get him to talk.
No.
Just get him out of the shell.
Yeah, the main reason why many people did not celebrate the 17th of March, which was the unification of the 150th anniversary of Italy, is not because of ideological problems or issues. It's because it was messed up big time, in the sense that the government, imagine this, you are going to celebrate 150 years of your anniversary, right? And you tell your companies and everybody that 17th March is going to be a public holiday a month before the 17th of March, okay? So many people said, look, we have to continue working because we did not budget for this. So there was besides this tells you a lot about what I'm critical about in Europe, the disorganization. The problems with Italy are structures and so forth, but I still do believe that in 1992, 1993, and now who is buying these bonds, these Italian treasuries, are essentially wealthy people. Where are the wealthiest people in Italy? Are central north. So it means that even those guys who are doubtful about unification of Italy are buying these treasuries. So on this particular point, I am not so bearish about Italian debt.
Yeah, thank you for your time. And now, can I ask about how do you think about the U.S. economy if the European problem continues? They don't die, but they don't survive strongly. Well, the unemployment rate is still looks a little better, and the Europe problem still is going on, and the emerging market, they are still good, but this year a lot of companies expect that their growth rate might be a little slower than compared to last year.
As the non-academic answer is that it appears that the U.S. economy is linked to the European situation. And so things have not been great this year. The emerging markets are also slowing down. You can see, I mean, Chinese production was almost the same as last year. It was 9, but I think that's lower. India is slowing down. Brazil was slowing down enough that their government has started new incentive programs as of December 1st. So I think everybody's in this boat with Europe.
I was just curious how, if they were to require derivatives to be traded on an exchange and have some capital backing, how that would affect, your corporation, and maybe if the rest of you could, respond to what you think the impact would be of that.
Yeah, this is the Dodd-Frank Act, and we haven't seen any of the regulations, so I don't exactly know how it works yet. But if it works the way people think it might work, it is not a positive for us in any way. Our credit rating is such, we're an investment-grade company, that we trade derivatives with our bank counterparties without collateral. And it's pretty clear that although there is an end-user exemption, supposedly exemption from the need to be on an exchange, we would stay in the over-the-counter market primarily because whatever they build on the exchange is unlikely to match our exposures. And if they do not match very closely, we will not get hedge accounting, and our income will go up and down kind of randomly with the mark-to-market on our derivatives. So we will stay in the over-the-counter market and most likely have to post collateral to our banks, so it is a drain on our liquidity.
John, you've got more experience trading derivatives than anybody here. What's your view on that question?
Well, I agree. I agree totally. Although, when you only have a very small amount of margin up and you have no collateral against it, bad things can happen. And, an analysis of your counterparty obviously is very, very crucial without an intermediary in between. As, you have listed derivatives, which are vanilla in nature. As she described, it's difficult to get exactly what you want. Now, Dodd-Frank might be just not robust enough to create what really should be created, which is an over-the-counter exchange where you can have your counterparty and design exactly what you want to have designed. But the only thing is that they are going to require higher margin. I don't know how much higher that is, but if you do a listed trade today, you put up 10% or 20% of the underlying. And I think that would prohibit a lot of participants, or really hurt the P&L of a lot of participants if that happened.
So is it a good thing or a bad thing? Should they do it or shouldn't they?
Well, I'd like to hear Greg's view on it. I mean, I just want to clarify too. I mean, we had a little private discussion. I believe in markets, but also I believe in there has to be some regulation. I mean, there has to be. We talked about Citicorp. I mean, it's just egregious that a bank can do off-balance sheet, hide assets and liabilities off your balance sheet. And derivatives is the one thing that makes that very, very easy to do. So I think eventually we do have to get to either an exchange that clears OTC derivatives, or we really have to have special rules to prohibit. And they have to be good rules, because bankers and traders and brokers are really good at getting around stuff. But there has to be better delineation of the risks that are really out there. And I think that caught caught some people by surprise. We knew it was out there, and that's why we were so bearish. But it needs to be done in some way.
So I think I mostly just echo what you said. A good friend of mine is the board's point person on this, and I had lunch with him in September, and he was telling me how difficult the problem was. Yeah, right. And so, Dodd-Frank's got 144 working committees. It's a very complex thing. Because I spend a lot of time hanging around in the Federal Reserve System, it's putting an enormous amount of stress on regulators right now. They're hiring like crazy, turnover's going up, people are retiring. I personally know nearly a dozen people that that either have retired early or want to retire now because it's not the same work environment. So having in that context, it's a very difficult problem. There are tremendous personnel demands on the regulators to solve this. Dodd-Frank did nothing to rationalize our incredibly complex regulatory apparatus with dozens of different regulators. So there's huge coordination costs. But one thing is for sure, we had a major problem. And the problem is we had a concentration of risk in one counterparty that nobody knew about, and AIG. And as costly as the solutions might be, I would argue that it's more costly not to have a solution. But then among the potential solutions, that's the issue. What's the least costly solution that we have that still offers some of the flexibility of and I don't know what that is, but I don't want to go back to a world where nobody knows where that counterparty risk is, because it's the systemic risk we're worried about. We're not worried about MF Global by itself going under, although we're a little bit surprised that could happen. We're worried about the financial system going under, and that in no small part was because of this unknown. And Geithner, interestingly enough, was screaming for 4 years before that to do something about it, but he was basically screaming into the wind.
I have to tell this story. It's a bad banker story. So I was meeting with some bankers from a large U.S. bank that you would all know in summer 2007, and I asked them, guys, what happens when the bubble breaks? Because it's clear there's way too much lending, pricing is crazy. Thank you very much, because I'm on the good end of that. But what happens when it breaks? And there were some very nice young bankers there who said, what are you talking about? I said, come on, guys. There's an awful lot of credit risk in the system, and it's going to break. And they said, oh, you're thinking about those old credit cycles. It's not like that anymore. I said, oh, okay, so tell me, because I'm old, so what's new? And they said, look, you think that, that the credit is the same as it used to be, but it's not, because it's all diversified. I said, okay, good. Who has the credit risk? They said, well, the hedge funds have the credit risks. I said, oh, okay, that's good, that's different. Who lends to the hedge funds? They said, well, we do. And that was their answer. So an older banker in the group called me the next day, and he said, thank you so much for yesterday's meeting. I said, why are you calling? He said, because I looked at you, and I saw the word moron on your lips, and you didn't say it. But it's amazing, the hubris of bankers, that they can't even look back 5, 10 years to see that exactly what happened before is going to happen again.
Well, this does dovetail back to your comments about Basel III, though. So one of the things that Basel III is attempting to do is to weed out some of this pro-cyclicality that you're talking about. But one thing is for sure, there is everybody who's studied it sees it. You see it in the data. I've seen it in commercial loan data. You see it in bond market data. And things get frothy in booms. And, you don't lend more than 40% against inventory coming out of a crisis. You're lending 65% against eligible inventory by the end, just as an example, then LTV ratios and equipment lending and everything else. And, but if you do something about it, from a regulatory point of view, you're going to get bankers screaming at you. And Jamie Dimon's leading the charge.
So a lot of you guys have kind of echoed at least that just looking at Europe, or at least in the U.S., we're kind of hitting this tipping point, at least where, I know John's talked a lot about it this semester during the IMA, where credit just becomes too big for either central banks or the markets to actually be able to deal with them. Do you guys at least foresee in the future, given at least a lot of within kind of government, a lot of at least the problems that they've had kind of having a fiscal union in Europe, where they can actually solve something, or do you more see kind of at least a lot bigger, at least market recorrection?
I didn't solve something.
Can Europe solve the problems, I think, or is it going to get worse?
Oh, well, whether Europe, you mean well, there are two Europes to a certain extent, right? There's the European Union and there's the eurozone. Okay, so let's put these together. Okay, but from an academic point of view, one has to pay attention to which Europe one is referring at the moment, because United Kingdom is not there, for example. In many countries, Sweden is not there, right? So it's very important to understand the difference. So this goes back to what I said before: solve the problem temporarily or solve the problem permanently. If we are speaking about solving the problem temporarily for this year, I think there are high probabilities that this will happen, right? If you are talking about solving the problem permanently, I have a lot of doubt, and the doubt is essentially because of the political risk. In Europe, unfortunately, there is no political leadership willing to make the changes that are necessary. Now, I'm not going to blame politicians for that, or only politicians. In economics and finance, we use the term endogenous. That is, everything is being determined at the same time. I think every country has the politicians that it deserves. And Europe is not an exception. We have the politicians that we deserve, and you can see that there is no public commitment to solving this problem. So take take what is happening in Greece. What else do the Greeks want to see that the system is broken, right? There is high debt, there is a huge decrease in bank deposits, so on and so forth, a big economic crisis, and still there is a lot of resistance to increasing competitiveness, because sectors in the economy that have been extracting grants do not want to give up. So I guess the question is, what does it take to solve the European problem? The European again, as I said, stimulus is not anymore an issue, because there is no money around to go around. Austerity is not giving the results so far. At least it's calming down the markets, but it's not giving the results. So the solution has to come from introducing a lot of flexibilities in markets. But to do that, there will be huge political outcries. So the question is whether politicians are really interested in essentially taking that risk. I said to you before that when you speak about the future, you have to speak about which future. In France, they were one of the reasons why they are worried, at least part of France, of the Standard & Poor downgrade is because it's happening in a presidential election.
Happened
right?
today.
So,
Happened today.
What did?
Standard & Poor's.
last week.
downgraded.
It happened last week. So they are worried not so much about one reason why they may be worried is because of the presidential election. So the question is, are politicians going to take to bite the bullet, do the structural changes that needs to be done, and we continue? And I have huge question marks about that, huge doubts.
So it just seems like they're just kicking the problem down the road, and eventually you get to a point where you just can't continue to kick it. Like you can't kick off the problems because they just get bigger and bigger. Like I just kind of, I mean, it seems like you're alluding and saying there's no solution, but kind of at least.
No, there is a solution. There are always solutions. There are always also good solutions. But what I'm saying is that the good solution is not costless, and I don't think that there is, as of now, the political commitment to make those big changes. That's what I'm saying. Now, this moving the can down the road, it's true. At one point, all this will come to an end. And the end game will be what will happen. Will the euro break up, or will there be enough pressures on the politicians to really make the big changes that are necessary? And if you think about it, even the first and more immediate thing, that is to have a European-wide treasury or something on that sort, has been has not been accepted. There is some kind of structure that goes in that direction, but nobody wants to give up, for example, national sovereignty. Okay, so I guess that's why it's the political commitment. To a certain extent, this crisis is being one of the main contributors to it is political inability.
Well, I think with that, I probably should call this to an end. Thanks again to our panelists.